Welcome to the next edition of Perspectives. Very excited today to talk more about private markets and more specifically around corporate lending today. But before I do start, I want to highlight the general advice disclaimer. Anything we discuss today is general advice only. Anyone acting on this advice without seeking financial advice does so entirely at their own risk. So today, I would like to welcome Joe Millward from Epsilon Direct Lending. Welcome, Joe.
Hey, Rob, thanks for having me.
Pleasure. Looking forward to the conversation today. So, Joe, tell us a little bit about yourself, your background, your experience, and why and how you started Epsilon Direct Lending.
Yeah, perfect. Thanks, Rob. I'm one of three founders of Epsilon, and I'll talk a little bit about myself. One of the real strengths of Epsilon is the incredible experience of the collective of the three founders and the investment team, the seven people that support us. And yeah, Paul Nagy and Mick Rice-Smith are my founding partners in Melbourne. Tremendous global experience in restructuring advisory and banking through the cycle. What I bring to Epsilon is funds management experience. Rob, I'm from the UK originally and had 26 years, 10-ish in the UK, and then the rest of the time here in Australia, and started a private credit fund in 2001 where there was no private credit market, built that to a €3 billion fund, managed that fund through the GFC, got all of our investors' capital back at the other side of the GFC. So I bring the battle scars of what it's like to work in our industry through a real downturn, and then pivot my career into a new country and got to meet my two business partners while working at CBA in their corporate bank, doing what we do now at Epsilon, which is mid-market direct lending.
Yeah, okay. And so, what brought you to Australia?
Oh, it's a little bit of back end of the GFC. Didn't like the way that Europe was going economically. Thought I'd have more career prospect and a bit of a change by moving closer to Asia. Recently married as well, and we didn't
Congrats.
want to raise a family in the UK. We thought we'd go somewhere a bit sunnier and nicer to raise some kids and move to the beaches of Sydney. And we've never looked back. We've got our entire family here now, and we're really happy and settled.
Oh, fantastic. So then why and how did Epsilon come about?
For the three of us, Rob, really quite different reasons, but the commonality is we were all at the point in our careers where we were experienced enough to give it a crack on our own, but still young enough to be energized and put everything into starting a business from scratch.
Mm,
For me, I wasn't a shareholder in the private credit fund that I'd started in Europe, but built a really successful track record. So wanted to give it a crack as a principal
mhm.
and saw that Australia was an incredibly nascent space when it came to private credit. This is going back 6, 7 years now. And we started the conversation between the three of us. I'd reached a stage in my career at CBA where I was probably at a natural juncture to make a change. And yeah, we had a few beers and decided just before COVID started to quit our jobs and give it a crack.
How many great businesses start over a few beers, Joe?
That's right.
It's always the way. So the purpose then was to start a business because you wanted to have a crack yourself. But was there a niche? Was there a calling? Was there an opportunity to start a private lending business in that space?
Yeah, 100%. There was a calling. What was happening is a lot of the private equity firms who buy businesses who we lend to support those acquisitions, we finance a part of that acquisition. A lot of those private equity sponsors said to us, we think you guys could do it a lot better if you quit the jobs at a bank and set up a private credit fund. A number of them had global offices, and so their US private equity counterparts were saying, what is it with you Aussies, man? You need to borrow and all you get is two term sheets from the major banks. Like, where are all the private credit funds? And so they were on us about the huge opportunity that their offshore colleagues had in raising capital, and so said, why don't you try and get the market here going? And a few private credit managers have started when we were starting that conversation. We're pretty heavily focused on other segments of the market, and we saw a real clear market opportunity, not in a niche, in quite a large segment of the private credit market, but it was just a very hard segment for people to start a private credit fund in and build market share in without the depth of the relationships and experience that we brought.
Yeah, I understand. So given you highlighted UK earlier, what percentage of the market is a private lender in the UK versus Australia?
Yeah, sure. So it's ballpark, depending on who you talk to, 50-50, bank, non-bank in the UK now. I think the
Oh,
US is like 85% non-bank now, 15% bank. Go back 20 years, it was similar to how it was here in Australia, where, around 10% of the market here now is non-bank, the rest is all bank. Do I see it going the same way as Europe or even the US? Yeah, possibly Europe. I still think the banks, because of the structure of the market and the regulatory settings, I still think the banks are really attracted to more homogenized corporate lending and real estate lending. There's definitely growth opportunity for private credit, but I think it will take some time to displace the banks just because they're still going pretty hard at the market and have a very low capital cost, so it can be quite heavily on price.
Yeah, I understand. Now, the perception, and I'm going to move ahead a little bit here, but I'm just thinking the perception of lending to a private market is always seen as potentially risky. Am I going to lose my capital? So, given your experience over all these years, what have you learnt and how have you constructed a lending criteria or risk management process to then be able to lend to companies and then to get our money back?
So first of all, Rob, I acknowledge the perception that people that might come from investing in public markets, because that's the traditional way in which you allocate investment opportunities. People are naturally skeptical, let's say, about private market investments, and there can sometimes be good due to the different regulatory settings, overlays, and transparency, and so on and so forth. But what I'd remind the audience of is that every single company starts life private, and over 99.9% of all lending instruments are in private format today. Companies choose to go private from an equity perspective. They choose to raise money from public debt markets, but they don't start life there. And the vast majority of capital is privately held right now. Residential mortgages, they're private,
Yeah.
even the most basic financial instruments. So the kind of due diligence that you apply when thinking about a private market asset is probably quite similar to the diligence that you have access to when you're evaluating a public market opportunity, when, in our instance, as a middle market direct lender, where we are often the sole lender, you have financial due diligence that conducted by a tier one firm like a PwC, a Deloitte, a KPMG, tax DD by the same parties, commercial due diligence by a leading management consultancy, legal due diligence by a top tier law firm. So you have substantial information that you can lean on to understand the investment opportunity. You have access to the people in the event of an acquisition, the people who are buying the business, and all of the due diligence that they've conducted in order to get comfortable with the equity risk. And we then take all that information, throw it into a massive melting pot, conduct a hell of a lot of analysis, a hell of a lot of market soundings about the opportunity, and then make an investment decision. And we're making that decision using our own capital as principals because we're invested in the fund, and thinking about investing for the long term in order to protect clients' capital and insulate against downside risk.
Okay, I understand. And so you're lending to the private market. Are there certain sectors that you are lending to at the moment and others that you're not, and why?
Sure, I should probably start by explaining what part of the market we lend to and how
Yeah.
we lend. So what we're not is property lenders. So we're not taking a view on the valuation of a fixed asset like a house or a factory and lending a percentage of that. We're lending to what we call operating businesses or going concern businesses. So these are companies that normally have a leadership position nationally in Australia. These are almost always Australian businesses, and they're a market leader, but in a segment or a sector that isn't a big enough addressable market to be ASX listed top 100, but they still occupy a critical component of our economy. Perhaps in a little while talk a little bit about some examples of those businesses and the sectors. But because we're lending to operating companies that don't necessarily have properties that they own, they're producing sustainable, predictable cash flows, what we focus on is analysing the sustainability and predictability of the cash flows that those companies are generating. And so when you take that to the next step, okay, therefore, what sectors are you focused on? It's sectors that aren't exposed to input volatility. So an example of that would be consumer spending. If you're lending to a clothing retailer and the consumer is worried about interest rates or paying the bills or redundancy, inflation risk and so on, goods are going up in price, that's going to lead to volatility of revenue across clothing retailers, and that lends to volatility across the earnings base. And so we tend to steer clear. We never say never.
Yeah.
It's clear that it's exposed to consumer spend and more on non-cyclical industries. So think education, healthcare, consumer food staple manufacturing, business services like an IT help desk business, for example. They're a lot more kind of resilient through market cycles.
Okay, and what is the criteria other than the sectors that you look for when you do lend to these businesses?
Yeah, there's no exact science to setting the numbers that I'll talk to, Rob. It's more kind of experience based, but we've got to draw a line somewhere. So we focus on companies that have turnover or revenues between 25 million and $500 million. We need them to have earnings or EBITDA of at least $5 million, and the minimum loan size that we provide is $10 million.
Right.
So what we're tending to do by setting those parameters is steer clear of the sole operator milk bar,
Mm.
the sole trader plumbers or maintenance services businesses that only operate in a small geography in New South Wales. We're steering clear of what are known as SMEs or small and medium enterprise businesses, and we're focused on what we call corporates. That's the kind of vernacular that banks use.
Yeah.
We came out of banks, so we use the same terminology. A little bit different to mid caps and large caps from a listing perspective. This is more
Mhm.
private market terminology. And when you have at least $5 million of earnings, when you have at least $25 million of turnover, generally speaking, you're quite well diversified by customers. You've got lots of them. They're normally quite well spread. You normally got a good spread of suppliers. We've got reasonable contracts in place, a reasonably defensive market position.
Mhm.
Um, Governance is pretty solid. Most of the time for larger companies, they normally have an independent board that might oversee the affairs of the business. And so a lot of the characteristics that lend to a high quality cash generative business tend to start at that kind of size and then go
Mhm.
up from there.
Yeah, okay. And how many opportunities would you look at or see over a period, and how many would you actually lend to?
Yeah, it's a big market. So there's 35,000 companies in what we call the mid market.
Mm.
25 to 500 million of turnover, 20 to 200 plus employees. That kind of, lots of data on that, but they're the broad numbers, Rob. And we built our portfolio at the CBA to around 3 billion Aussie dollars. We believe that the total loans outstanding to medium-sized companies that are borrowed for growth, so that might be an acquisition, it might be an expansion program that they go through, is
Yep.
about 70 billion Aussie dollars. Right now at Epsilon, we're seeing about $1 billion of funding requests from companies per quarter. So $4 billion a year of funding requests across a couple of hundred companies a year that are seeking to borrow from us in order to support their growth.
And the loan size for Epsilon at the moment is, or the amount of loans you've got out with customers? Just.
Yeah, so right now we're averaging about 18, $19 million per loan.
Mhm.
We've got 15 loans in the senior loan fund, 16
Okay.
in the direct lending fund. So we're sitting just shy of $300 million of loans out the door.
Okay. So yeah, so you're screening a lot of opportunities, but you're only lending to a select few.
Yeah, that's right. Yeah, historically we've funded around 5% of the opportunities that have come our way. So put another way, we're declining 19 in 20
Yeah.
opportunities. But we're highly selective and we're
Yeah.
we're pretty proud of that, and we're very transparent about that with borrowers as well.
That's what we'd like to hear. So then you mentioned briefly acquisitions or growth. What are some of these loans more specifically used for? And can you give us some examples of that?
Sure, 80% of the companies that we've lent to are owned by a private equity firm. These are, dedicated middle market private equity firms that are investing in performing corporates where normally there's some kind of succession event. The founder or multi-generational business owner is seeking to exit because they've got to that age and stage,
Mm.
and a private equity firm is buying it off them because they see real strong growth prospects. And what we're doing is, hypothetically, let's say the company's valued at 100 million Aussie dollars. The private equity firm might stump up $60 million of that from their private equity fund, and we'll stump up the other $40 million from our private credit fund. We're a senior secured lender. So we're the first people to get our money back if there's underperformance, and then the private equity firm is hoping to make a leverage return using our debt, a leverage return on that $60 million investment through a combination of improving the earnings of that business and also potentially buying other businesses to bolt onto it.
Got it. And so you spoke about security. What kind of security do you take when you lend that $40 million?
Yeah, it's the Rolls Royce of kind of security packages. Australian insolvency and corporate law is pretty strong from a creditor or lender perspective. So we take, senior secured loan over the entire operations of the business. So without getting too tech, we take a mortgage over the shares of the holding company at the very top. So if we exercise our security at that level, we effectively own the business and can operate it. Or we can enforce our security at operating company level. So let's say there's a subsidiary of that business that's going really well, but the wider group is underperforming. We can take on that subsidiary and sell it off to realize our value of our security. Or we can enforce against any assets that the business have, floating or fixed, so receivables, inventory, or potentially other fixed assets, vehicles, factories, and so on that they might own. So really flexible security package with nobody else that sits above us in the security structure.
Mhm.
That means that you maximize in the event of underperformance of a business, you maximize your recovery rate.
So do you think that the market doesn't really understand the value of private credit here?
We hold the keys in the event of a downturn for sure. We're not running the businesses from a day-to-day perspective, but of course our returns are capped as well, right? We're not looking to make 3x our money. We're looking to generate sustainable, predictable returns for our investors. And there's a cost to having a senior secured position, which is the lack of upside. Is there a perception issue? Yeah, possibly when it comes to understanding the intrinsic value of operating companies. So what I'd encourage listeners to do is to look at the US stock market and pick the top 100 companies and ask how many of those companies have enormous fixed asset bases. What you'll find is that by far the most valuable assets that the vast majority of all of those massive US listed companies have are intangible assets.
Mm,
Is the brand at Coca-Cola. It's
mm,
Amazon's incredible digital footprint globally. It's Netflix's P and content that they've secured, and so on and so forth. So a lot of companies have, and I'm talking about obviously very well-known enormous companies here, but at the next level down, talking about middle market companies in Australia, we're lending to companies that have substantial market leadership positions. And yes, they only have, or say only, they have intangible assets as their asset base, but that doesn't mean that they're suddenly going to disappear and that loan would be worthless. The opposite is true. The long-term recovery rates through the cycle for operating businesses is actually really strong. The rating agencies have proved that out through multiple cycles of data.
yep. And so you did mention earlier risk and probably the return of equities uncapped, whereas our return is capped because of the conditions or the loan structure. You delivered about 2.3% after fee return for the last quarter, so annualized at about 10 to 12. Do you think that is potentially a consistent return should be expected for investors?
I'd start by saying capital's at risk, Rob. You don't get to generate swap plus 4.5. Our target return is swap plus 4.5. You don't get to generate those returns risk-free,
Hmm.
right? There is a possibility that some of our loans default and we don't receive a full recovery in exchange for the security we have. But what we're aiming to deliver is defensive recurring income with low volatility and low correlation to other asset classes. That's our aim.
Hmm.
We're personally invested heavily in these funds. We have performance fees that create strong alignment with our investors around the performance of these loans. As a shareholder at Epsilon, and my business partners and I were incredibly motivated to the long-term successful outcomes delivered to investors. That's what plus 4.5 in the instance of the senior loan fund. And we do that by originating really high quality cash generative loans that are performing, that the banks want to lend to. This isn't
Hmm.
a segment of the market that the banks are retreating from. We're competing against the banks for their products, and ultimately deliver growth to those end markets. To corporate Australia, we're supporting the growth of businesses where our capital is being used for a really positive purpose.
Given you spoke about the swap rate, can you explain what that actually is? If the RBA cash rate has just fallen to 4.1% from 4.35, can you explain what the swap rate is and what impact that has for investors of the fund?
Yeah, sure. Without going into the kind of weeds of the genesis of the swap rate, historically, the BBSW is as it's known, and there are different kind of durations, interest rate durations of BBSW, 1, 3, and 6 months are the most used. That is the rate at which banks used to lend to each other at from a wholesale funding perspective. So the banks, with quite strong reference to the cash rate, the RBA
Mm.
rate, there's a very strong correlation between the BBSW rate and the RBA rate. The banks set the borrowing rate between themselves, and that's the rate, therefore, that banks lend to corporate Australia at. So because the vast majority, 90% of the market, is lending at BBSW plus a margin, Epsilon lends at that level as well. What
Mhm.
investors should experience, no guarantees, but should experience, and historically have always experienced, is very high correlation between the RBA rate and that swap rate. We use the 3-month swap rate. So that means our borrowers pay us the swap, 3-month BBSW plus a margin, and we collect all of that income every quarter end and pay all that income onto our investors each quarter end. So when the RBA rate declines, you will see with time, after 3 months or so, a small decline, a commensurate decline in the BBSW component of our return.
Okay. And given where we are in the environment at the moment with elevated inflation, higher than, it's not actually even that high interest rate, but it's higher than we've been used to for a certain period, and potentially slowing economic growth, although what we've seen recently is the economy feels like it's bottomed out and picking up a little bit. How do you see the outlook for lending in Australia? Do you still have to be selective on who you lend to? And do you feel like the default risks come down a little bit? What's your views on that?
Sure. So the two things at play that have led to where we're at today, obviously COVID was a huge driver, and the government stimulus of inflationary environment leading to rate increases, and that seems to have tapered a little bit in recent months, leading to the most recent rate cut. You've got some consumer stress out there, although that seems to be easing. Recent bank reporting suggests even construction businesses are starting to do a little bit better off some pretty bad conditions over the last few years. And whilst we definitely keep an eye on all of those factors, we seek to lend to companies that weather all market conditions. And we're coming off a position where, yes, the interest rates have increased, but are still fairly close to long-term averages, right? We've just had it very low for quite a long time. But interest rates aren't that high relative to historic averages.
Mm.
And our weighted average interest cover ratio, which is the ratio of a company's earnings in our portfolio to their interest bill, is sitting above 3 times right now. So 3 times earnings to interest. That means from a math perspective that earnings can decline by 60, 70% before interest would be challenging to meet by our borrowers. And coming back to the point I made earlier, because we're focused on lending to non-cyclical industry companies, 80% of our portfolio are in non-cyclical industries, because we lend on really conservative settings on the way in. The loan to enterprise value ratio of our weighted average across our portfolio is 42% or so right now. Yeah, equity have got to lose 58%. The company's got a decline in 58% in value before, on a weighted average basis across the book, the portfolio will be at risk of impairment. Because of those reasons, we're not impacted by these short-term headlines, the short-term moves in market, the smaller spikes in inflation, small movements in interest rates. What we're focused on is the long-term, sustainable, predictable nature of a business's earnings, their cash flows, and why it is that they can weather any kind of economic changes that might come their way.
Mm-hmm. Fantastic. It's reassuring for investors, so thank you very much. Now, finally, Joe, just your views on the ASIC white paper that people are proposed to implement or provide some information on data gathering and their views on transparency. Now, given your background in the UK market, are you seeing that there are similarities, or does Australia have a long way to go to improve that level of transparency to promote and allow more and more people to invest in private credit in Australia? What are your views there?
Yeah, sure. It was just released a week ago. So I think both from Epsilon's perspective and I sit on an industry body as well, we're penning a response to ASIC on behalf of the industry. From those two perspectives, we're still digesting the report and trying to figure out what it means at a detailed level. Some high-level observations, though, Rob. The paper covered both public and private markets. It wasn't exclusive to private credit. The high-level goals of ASIC were to ensure the attractiveness of the capital markets, public and private, to promote strong investment and economic growth, whilst getting the balance and protecting against risk. And the paper doesn't make any specific changes. They haven't put forward any specific changes that are going to affect our industry in the foreseeable future. It's very much a consultation paper to hear from industry, to hear from market participants about how it is the market views the ability of private and public assets to coexist, because they always will, whilst promoting that strong investment and economic growth and protecting against downside risk. Now, that's the kind of big picture. As it pertains to private credit specifically, ASIC noted that because of the small size of our market right now, I mentioned earlier, it's still a nascent space, around 10% market share. Depending on the source that you look at, it varies quite a lot. RBA considers that the direct risks to financial stability from the market appear low, but there may be implications for investor outcomes and so on in the future. It's something that should be looked at. And what I'd say is, holistically, we really welcome regulatory engagement at Epsilon. We think that some of the observations they've made around areas of risk, the key risks that were highlighted across opacity, conflicts, valuation uncertainty, illiquidity, and leverage in private credit specifically, are really good observations. We agree with them. We've always sought to maintain a high level of transparency for investors, transparently disclose how we manage conflicts, how we manage valuations, how we manage liquidity, and so on. With any growing market that's in the earlier stages, you're going to have a broader range of investor outcomes and market participants than you would in a more mature market, and ASIC simply seeking to work with industry in order to mature it. That's similar to how the regulators in the UK supported the growth of that market, which continues in the UK and the US to co-invest really positively and strongly with the public markets.
Great summary, Joe. Much appreciated, and great to hear that you're part of the body that's putting back the recommendations back to ASIC to grow this industry, because it really is and does support our investors' allocation towards a multi-asset strategy to generate returns. And given where the current rate of return is, it's very attractive. And it sounds like Epsilon, yourself and the team there, aren't really taking unwarranted risk, albeit there are always risk in what you do. With the default, you're looking at sustainable businesses, you're focusing on quality sectors and companies, you're taking security across what you lend to, and you're relatively protected given that you're not stretching the balance sheet on the interest rate cover ranges and ratios. Joe, if there's anyone out there that's listening that wants more information on Epsilon Direct Lending, where can they get that information from?
First port of call is Rob Pizzichetta and the great business that you're building, mate. But if you want to contact us directly, then you can get in touch via our website. I'm on LinkedIn. We're at www.epsilondl.com.au and welcome any discussions with people that want to learn more.
Joe Millward, thank you so much for your time. Have a great weekend.
Thanks very much, Rob.